Hey, my name is James Nicholson and welcome to my YouTube channel. In this video, we've got a big update from economists on where interest rates are heading. Could they be going down as quickly as they did in 2008? Well, this might surprise you. There's actually a lot more cuts predicted than were expected even just a few weeks ago. So in this video, I'm going to talk about what economists are saying, and one economist that are saying massive rate cuts by September this year. So you're going to want to know all of this information so you can make the right decision if you're purchasing, remortgaging, or even if you just want to know what's going on in the market. Now, if you're new around here and you haven't done already, make sure you subscribe to the channel over there and hit the bell notification. We are literally a smidge away from 41,000 subscribers. Have a look around this video. It's about 20 subscribers we need. So do subscribe and help us get there. And let's get some more views on this video. How do we do that, you ask? Simple. Smash like, tickle like, do something to the like button. That really helps with the YouTube algorithm. And I appreciate everyone that does that. And then share the video. I'm sure you know somebody that's looking to remortgage that could really benefit from knowing what's going on in the market. So, 2008. What a difficult, strange time that was. The credit crunch. Now, in 2008, house prices were dropping at an alarming rate. Lenders weren't lending money, and that was really a bad scenario. So the Bank of England cut rates very drastically. In fact, I'll tell you how quickly they cut them. They cut from in October of 2008. This is how fast rates went down. They were sitting at 4.5%. Interesting. That's where we're at right now. But by March of 2009, rates had gone all the way down to 0.5%. That was a crazy drop. Now, a lot of people think that that won't happen again, or at least it won't happen for a very long time. Things were different in 2008. There was a lot of reckless lending leading up to that. I've spoken before, and maybe you had one, about something called a self-cert mortgage. That's where you went to your broker and you just told them how much you earned, and nobody really checked into that. And so people were inflating their incomes to borrow more money. And the worst products out there were 110% mortgages. So let's say you bought a property for 100 grand. They would give you £10,000 cash back, effectively banking on the fact that house prices would continue to rise. When they dropped, a lot of people got into negative equity. They couldn't afford the monthly payments, and that ultimately led to the financial crisis that we saw. So what are we expecting to happen over the next few months? Well, economists have changed their stance. So what they're now saying is that we will drop 1% down over a 6-month period. So by the end of this year, that means the base rate will be from 4.5% down to 3.5%. That would mean that your mortgage rate that you can get would significantly drop as well. If you're on a tracker rate, for example, you would have a big drop off in your monthly payments, which would benefit a lot of people greatly that sit on those tracker rates or have taken those out on a hedge that they feel that they will be making the right decision because rates will go down. But there's also an outsider in this as well, and that's Barclays. Now, Barclays believe this is going to happen way faster than that. And so what Barclays are saying is that they feel that the base rate will drop all the way down to 3.5% by this September. And they're basing that on the fact that this tariff war that's happening is going to cause a global recession. No one's really budging on this. The Donald Trump party are saying, look, China needs to get in touch. China's saying, you basically drop all the tariffs and then we'll have a conversation. And no one's budging on that. And what's expected to happen in the next few weeks is a shortage of goods in America. That is going to slow the economy down for sure. Now, that will ripple all around the world. We potentially, in the EU and Europe and us separate on our own, China could dump a lot of excess goods onto our economy at a very low price, which is good for consumers, but that could lead to deflation as well. So that's what Barclays are saying. They feel that this cut in rates is going to be a lot faster. Now, interestingly, there are 4 meetings between now and September. So that is possible that you could get 4 consecutive 0.25% cuts, and Barclays would be bang on the money for that. So that means that mortgage rates are going to go down. That means that tracker rates are going to go down, and that could stimulate the market a little bit, because the market right now is slow. And that's because you've got the stamp duty increase, and there are people that are just waiting out. They're saying, you know what, I want to get a better rate, but I know rates are going to go down, so I'm not going to move and do anything until I see those rates moving in the right direction. So it's really an interesting time. Now, a lot of lenders have already cut below the magic 4% rate. We've done lots of videos in the last 2 weeks on that. Everyone out of the big 6 lenders have already cut rates, which includes NatWest, HSBC, Halifax, Nationwide, Santander, and Barclays. All of those major 6 lenders now have rates below 4%, and some of them have multiple rates. I think it was HSBC has 16 different products now that are below that 4% rate. 3.79 is the headline leading rate by Halifax at the moment, but that's still getting more competitive. Every time I look, there are other lenders now cutting rates and joining that as well. So look, this could be positive for you if you want a lower monthly mortgage payment, which is good. But on the downside, if rates are going to go down as fast as Barclays are predicting, that means the economy isn't looking very strong. And that's the belief here, that the economy isn't looking strong, that we could potentially go into a recession. America could go into a recession as well. And that isn't good for the global economy as such. But some of us will benefit from that. So if you want lower rates, this is something to definitely keep an eye on. Now, what will happen is that if this starts getting priced into the market, so if other people believe that Barclays are right on the money here, then you'll see something called the swap rate. The SONIA swap rate will start to drop. If that starts to drop, even before September, you'll get lenders that will lend you money at a cheaper rate. And so that's important to keep an eye on this stuff and see what happens. Now, if you've got a remortgage coming up in the next few months, here's what I would do. I would fix a rate now. And then if the rate drops, as long as you haven't started that new product, let's just say you had a new product that was coming up for renewal in October, you can fix the rate today. Then if between now and October rates drop, that lender has a better rate, you can swap onto that before you start. That locks in that better rate and gives you the worst case scenario. So should rates go up, you're protected as well. Let me know what you think about this. Who's on the money here? Do you think the economists are right saying rates are going to drop by 1% by the end of the year? Or do you think Barclays are more correct here, where they're saying actually it will be way more condensed than that and it will happen by September? I'd love to know your thoughts and opinions. Do smash like, do share this video with someone that needs to know what's going on in the market, and check out all the other content as well on the channel, including this video right here.